You just saw how the centralization cycle created the Federal Reserve in 1913. Now let me show you what happened next, because the pattern didn't stop at Jekyll Island. It repeated 5 more times. Each time, crisis, intervention, more power, and each time the same people stayed in control. Let's start with 1929, the Great Depression. In the 1920s, the Federal Reserve flooded the economy with cheap credit. Interest rates were kept artificially low. Banks lent recklessly. Stock prices soared. Everyone believed the boom would last forever. It didn't. In October 1929, the stock market crashed. Banks failed by the thousands. Unemployment hit 25%. The economy collapsed into the worst depression in American history. And here's the part they don't teach you in school. The Federal Reserve caused it. By expanding credit in the 1920s, the Fed created an unsustainable bubble. Then, when the bubble burst, the Fed made it worse by contracting the money supply by 1/3 between 1929 and 1933. They turned a recession into a depression. Milton Friedman, one of the most respected economists of the 20th century, later proved this in his research. The Great Depression wasn't a failure of capitalism, it was a failure of the Federal Reserve. But here's what happened next. Instead of being abolished for causing the crisis, the Fed was given more power. The centralization cycle repeated. Stage 1. Chaos. The Fed created a credit bubble, then crashed the economy. Stage 2. Public panic. Millions lost their jobs, their savings, their homes. Stage 3. Secret meeting. Franklin D. Roosevelt and his advisors designed the New Deal. Stage 4. Centralized control. The Fed gained new powers. The Gold Reserve Act of 1934 gave the government control over gold. The Banking Act of 1935 restructured the Fed and gave it even more authority over monetary policy. The institution that caused the Great Depression was rewarded with more control. Crisis 2. The 1970s. Stagflation. Fast forward to the 1970s. The Federal Reserve under Chairman Arthur Burns printed money to finance the Vietnam War and President Lyndon Johnson's Great Society programs. The result? Inflation exploded. By 1980, inflation hit 14%. Interest rates soared to 20%. Unemployment was high. Economic growth stalled. It was called stagflation, a nightmare scenario where prices rise, but the economy doesn't grow. The Fed had broken the most basic rule of economics. You can't print money without consequences, but once again the centralization cycle kicked in. Stage 1, chaos. Inflation destroyed savings, the economy stagnated. Stage 2, public panic. People demanded action. Stage 3, secret meeting. Paul Volcker was appointed Fed chairman in 1979. Stage 4, centralized control. Volcker raised interest rates to 20%, triggering a brutal recession. Millions lost their jobs. But inflation was crushed, and the Fed's reputation was restored. The message was clear. The Fed could create the crisis and then save you from it, and you'd thank them for it. Crisis 3. The 2008 financial collapse. Now let's talk about 2008, the crisis that changed everything. In the early 2000s, the Federal Reserve, under Alan Greenspan, kept interest rates at historic lows. Cheap credit flooded into the housing market. Banks handed out subprime mortgages to anyone with a pulse. Wall Street packaged those toxic loans into securities and sold them around the world. It was the 1920s all over again, a massive credit bubble fueled by the Fed. In 2007, the bubble burst. Housing prices collapsed. Lehman Brothers failed. The global financial system froze. Millions of Americans lost their homes, their jobs, and their retirement savings. And once again, the Federal Reserve, the institution that created the crisis, was put in charge of fixing it. The centralization cycle repeated. Stage 1, chaos. The housing market collapsed. Banks failed. Credit froze. Stage 2, public panic. Congress passed the $700 billion TARP bailout. Stage 3, secret meeting. The Fed Treasury, and Wall Street executives coordinated behind closed doors. Stage 4. Centralized control. The Fed launched quantitative easing, QE, a fancy term for printing trillions of dollars out of thin air. Between 2008 and 2014, the Fed's balance sheet exploded from $800 billion to $4.5 trillion. They bought government bonds, mortgage-backed securities, and corporate debt. They bailed out the banks that caused the crisis. And here's the kicker. The people who lost their homes got nothing. The banks that caused the collapse got trillions. The Fed didn't just survive the 2008 crisis. It became the most powerful financial institution in human history. Crisis 4, COVID and the money printing spree. Then came COVID-19. In March 2020, the economy shut down, the stock market crashed, unemployment spiked, and the Federal Reserve did what it always does. It printed money. But this time it went further than ever before. The Fed's balance sheet exploded from $4 trillion to $9 trillion in just 18 months. They bought everything: government bonds, corporate debt, mortgage-backed securities, even junk bonds. They propped up the stock market. They kept zombie companies alive. They flooded the system with more money than at any point in history. Congress sent out stimulus checks. The Fed kept interest rates at zero. And for a brief moment it felt like free money was raining from the sky, but there's no such thing as free money. By 2021, inflation started creeping up. By 2022, it hit 9.1%, the highest in 40 years. The price of groceries, gas, rent, everything exploded. Your savings lost purchasing power overnight. The Fed had done it again, created a crisis through reckless money printing, then acted surprised when inflation showed up. And once again, the centralization cycle played out. Stage 1. Chaos. COVID lockdowns crashed the economy. Stage 2. Public panic. People demanded government intervention. Stage 3. Secret meeting. The Fed coordinated with Congress and the Treasury to unleash unprecedented stimulus. Stage 4. Centralized control. The Fed's balance sheet doubled. Its power over markets became absolute. It now owns a massive portion of US government debt and mortgage securities. The Federal Reserve didn't just respond to COVID, it used COVID to expand its control over the entire financial system. Crisis 5, 2025. The cycle repeats, which brings us to right now, October 2025. Inflation is at 2.6%, still above the Fed's 2% target. The Fed just cut interest rates by 50 basis points in September 2025, the largest single cut since 2020. They claim they need to support the economy, but here's what they're not telling you. The US national debt just hit $35 trillion, that's 123% of GDP, the highest since World War II. The government is running a $1.8 trillion deficit. Interest payments on the debt now exceed $1 trillion per year, more than the entire defense budget. And the only way to keep this system running is for the Fed to keep buying government debt, which means printing more money. We're in the early stages of the centralization cycle again. Stage 1, chaos. Inflation is sticky, debt is exploding, cracks are forming in the system. Stage 2, public panic. It hasn't fully hit yet, but it's coming. When the next crisis strikes, whether it's a debt crisis, a banking crisis, or a currency crisis, people will demand the Fed do something. Stage 3, secret meeting. Behind closed doors, the Fed and Treasury are already preparing the next intervention. Central bank digital currencies, CBDCs, are being tested. New monetary tools are being designed. Stage 4, centralized control. When the crisis hits, the Fed will step in with even more power. They'll launch new programs, print more money, expand their balance sheet, and the cycle will repeat. But here's the difference this time. You can see it coming. The pattern is clear. Let's review what we've learned. 1913. The Fed is created to prevent crises. 1929. The Fed causes the Great Depression, gains more power. 1970s. The Fed causes stagflation. gains more power. 2008, the Fed causes the housing collapse, gains more power. 2020, the Fed prints $5 trillion during COVID and gains more power. 2025, the Fed is preparing for the next crisis, and when it comes, they'll gain even more power. Every single time, the pattern is the same. The Fed creates instability through loose monetary policy. A crisis erupts. Public panic demands intervention. The Fed steps in as the savior. The Fed gains more control over the financial system. This isn't a bug. It's a feature. The Federal Reserve was never designed to serve you. It was designed to centralize control over money, credit, and economic power, and to do it in a way that makes you believe you need them. What happens when the Fed can't print its way out of the next crisis? What happens when inflation spirals out of control and rate cuts stop working? What happens when the dollar itself becomes the problem? Here's what I haven't told you yet. The centralization cycle has a final stage, one that's never been deployed in history, and it's already being built right now. In part 3, I'm going to show you the endgame, the financial reset that will end cash, track every transaction you make, and give central banks control over your ability to spend, save, or even access your own money. This isn't theory. The infrastructure is already in place, and once you see it, you'll understand why every crisis since 1913 has led to this moment. Stay curious, stay skeptical, and I'll see you in part 3.